Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott to discuss all things small cap. So, big welcome, Paul.
Thanks, Paul. And sorry, but your video keeps freezing, but I can hear you fine. So let's plow on.
Oh no, not again! I haven't got a clue. I've been sort of like plagued by this technical problem. I've turned my router off anyway. We'll wait and see. As long as you can hear me, and
I can hear you crystal clear. Yes,
I'll try and put some charts on as well. Anyway, given the volatility in the first 3 months of this year, what with the war in Iran, then we've had worries over agentic AI, plus fears over the private credit market. How's your portfolio performed in sort of Q1? Mine's had a total bath.
Yeah, mine has as well. My long positions have been absolutely walloped in March, which was a pity because up until that point I've been doing all right. But I think it's the same. We're all in the same boat. Everybody I talk to has had a really bad March, unsurprisingly, because it's just been a panic sell-off because of geopolitical issues and perfectly valid concerns about supply of oil and gas, which we could be about a week away from shortages and I think the news flow is going to get worse before it gets better. But I don't focus on those things. For me, I'm a medium to long-term investor. I look through these sort of temporary difficulties. And of course, I did have shorts in position, which absorbed most of the impact. Well, I closed all those yesterday morning, actually, which was lucky timing. So overall, it hasn't been too bad, but mainly because I was hedged.
Yeah. And have you been buying it or selling anything? Obviously, you've sold your shorts, haven't you? You've just said.
I closed the shorts yesterday. This is in a relatively small trading account. I don't hedge my main shares accounts, but yeah, I've been buying loads. I've been buying. Do you want me to quickly run through what I bought?
Yeah, might as well.
I've topped up a lot of my existing positions because I take the view that actually often the best bargains are already in your portfolio. So I've topped up likewise the floorings distributor, LIKE. A new position, 2 new positions, Barrett Redrow, BTRW, and Craneware, CRW. I've topped up Brickability after the bid approach yesterday, BRCK. I've topped up yesterday, James Halstead. I'm going mad on floor coverings here. And today I topped up Tops Tiles. Unfortunately, after a very misleading RNS, which sounded like it was in line. And then I only discovered after I'd topped up that actually it was a 20% profit warning. So Tops Tiles, I'm livid with them. But I've also topped up Alumask today. So all of those are names I've been positive on now for months. So finally having some cash to deploy today and yesterday was lovely. Yeah, very nice. How about
with those for Tops Tiles and also Alumask, have you basically you're playing that cyclical recovery? Are you in sort of building products companies?
Yeah, I'm heavily exposed to that. I mean, I'm looking through all the current macro. I think Tops Tiles is fabulously cheap, but obviously they've really miffed me today by slipping out, doing the worst thing companies can do, which is to basically deceive you in the RNS, making out it, obfuscation, whatever, to make it sound like it's okay. And these very vague, woolly RNSs are rarely good news. And then they slip out a 20% cut in forecast through Edison, which is direct from the company. I mean, that is outrageous. Frankly, the FCA should be all over them. And if they were in America and they did that, they'd be up in court facing a lawsuit. And I think maybe it's time that actually a group of us in the UK do actually take legal action against some of these companies that do such blatant. And of course, now I don't trust the company and I don't trust the new CEO who's been there 3 or 4 months, although maybe, she's too new to bet. But, you take the top job, you take responsibility for the company's communication. So I'm very, very annoyed with Tops Tiles, but I mustn't let that anger obscure the fact that the shares are terrific value. And you're now getting a 9.3% dividend yield on Tops, which they can afford to pay. So I think, separate the emotion, the justifiable anger with their deceptive communications, there's no other word, in my opinion, and the value in the shares, which I think is terrific.
Yeah. No, it's strange, isn't it? Because the building products companies I've spoken to over the past couple of weeks, I've spoken to sort of Michelmerse, for instance, and
Oh
they've
yeah.
all said the same sort of thing. So I think Barclay Homes came out with an update as well, saying January and February were pretty good, which is sort of counterintuitive because the weather was terrible. I mean, if you think about the building trade, it was a total washout. But that for those first 2 months, it was pretty good. So what that says to me is that when the conditions are correct, consumers and people want to get onto the housing ladder or move, because we had mortgage rates coming down in the first 2 months, and then it's only been the uncertainty caused by the war in Iran that has actually put people off sort of like buying houses, because they have everything sort of like taken a bit of a pause in March. But if you get the conditions correct, if the worries about Iran die down, by a sort of logic, the demand is still there. So I'm with you. I think this is just a temporary pause with the war, and you might well see that actually people start buying houses and renovating houses as soon as we get sort of clear sight of sort of the end of that particular conflict, which may or may not be that far off. Certainly by June, etc. Because it isn't like the bottom of the financial crisis where nobody wanted to move and everybody was just hunkering down. This is very much they were going to move, and everybody was the building products sector was actually doing pretty well in the first 2 months before the conflict came out. So I'm with you. I think this is just noise at the moment. I mean, it's very painful, but it is just noise.
Yeah, I agree. I think it's all poised for a recovery. I mean, we've been saying this for several years, and the recovery starts, then something else knocks it back, doesn't it? But you always have, I mean, throughout my whole sort of life, really, there are always housing transactions going through, even in the most grim circumstances. And we're probably at or around, the long-term, just the base level of transactions, because people move house with help from parents and grandparents and whatever. It's almost hereditary now, owning houses in the south of England. You can't do it on a salary multiple, but I'm talking to plenty of people who are looking at buying places. The mortgage rates, funnily enough, I was looking at those this morning, because a 2-year fix on my buy-to-let flat, unfortunately, is coming due in the next 3 months. The rates are pretty uncompetitive. It's going to involve a hike. The best 2-year fix I could come up with was 5.94%, which is an obstacle. And the existing rate I'm on is 4.74. So there's no doubt that short term, for people who do want to take a mortgage out and take it out at current rates, this is an obstacle. But it hinges more on the swaps, doesn't it, and the 10-year gilt, which actually is starting to come down now from the recent peak. So I think you've hit the nail on the head. To me, this is background noise. It's not permanent, but the market is pricing the house builders and the building products companies as if this is going to be like this forever. Well, that to me is obviously just a massive mismatch, and that's your opportunity, isn't it?
Yeah, no, I totally get it. Okay, let's go to one of the building products. We've got Brickability, or Brick as they call themselves. They got an offer, or sort of like a potential bid from US private equity earlier this week at 65p. The shares have shot up, but they're still only 53. I know the bid was rejected. How did you read this one?
I bought some more yesterday at 53 because I'm an existing holder. I've been saying for a while this is just bonkers cheap. It keeps putting out inline updates as well, even though bricks and other building products distribution you wouldn't have thought would be a particularly buoyant area, but it keeps surprising. The only slight setback was that there was some director selling last year, which took me by surprise that they would sell at those sorts of low prices. But you've got now the yield is more than the PE. On Brook, if that's how it's pronounced. They've been taking a leaf out of Aberdeen, haven't they? Dropping the vowels to save ink, maybe. But anyway, I mean, I think, somebody coming along and saying, right, we want to buy it at a 59% premium, Atlas. I looked them up, and they're a US, as you say, private equity operator that focuses on buying distributors, so a very good fit for this. And Brook have basically said to them, go away and come back with a better price. So that says to me that the company's now in play. They've gone into the takeover panel rules. Atlas then came back again and said, well, we need more access to due diligence materials. So it seems to me both parties seem receptive to it. Would I be happy with 65p? No, but 70 to 75p would do it for me personally, which would be a very nice premium to the 53p we are now. And I think the shares are fundamentally worth probably £1 to £1.20 in a bit of even a modest economic recovery. So I mean, you couldn't ask for a better each way bet in my view. So yeah, very, very bullish from my point of view.
Yeah, and also it sort of like indicates that there are buyers out there despite the volatility.
Yes.
I mean, they view this as just temporary noise rather than actually fundamentally the broken economy.
Yeah, that's a great point. Because funnily enough, I think it was last week or the week before we were discussing this, weren't we? And we were saying, well, are all these takeover bids now that are in progress going to fall over? And the bidder's going to say, whoa, you know, macro's too difficult now, interest rates going up, and walk away. So that, which we don't know, we've still got quite a few in progress. But the fact that, as you say, a brand new bid arose this week from private equity in the US, I think that's really bullish, because I think you'll get loads more bids from the US, and they're already kind of brushing this off, aren't they? A huge rebound on the Dow and the Nasdaq this week. So yeah, very, very encouraging, I think.
Yeah, another one on which has actually received 6 unsolicited bids and decided to put itself up for sale is Checkit, which basically does Internet of Things monitoring. So, as an example, it might well be doing remote wireless monitoring of temperatures on freezers, etc., or some other piece of equipment at a customer's premises, etc. Anyway, what's your sort of take on this one? I mean, it hasn't been profitable historically as it's grown, but I think it's now taken out quite a bit of cost, and obviously the shares have responded pretty favorably given the board has decided to put themselves up for sale.
Yeah, we flagged this actually on the 19th of February as an improving situation. We moved it up a notch from amber red, which is kind of, you know, watch out, bit wobbly, to just amber, which is actually, we think it's okay now. So it's a pity, like you say, it would be a pity, I think, if it got bought out, just as it actually finally, after quite a long period of time, cash, burning cash and whatnot, it now seems to be coming good. They've drastically cut their costs. This is the one where they slashed £4 million from the costs, which, I mean, you know, must have been the bulk of their payroll, I think, because it's only about 12 or 13 million revenues. So yeah, it'd be a pity to see it taken out, because it seems to be actually coming good now.
Yeah, I think one side of the, you know, it's recurring revenue streams, which is great. I think that's what people are attracted to. The only thing is it's a bit like Brew Lines, isn't it? Off who was it? Who owns?
Oh, Vianet.
Vianet, yeah. So you've got to look at it all comes down to growth, isn't it? Because Internet of Things has been around for some time. But having said that, you know, if you've got 6 interested parties, or effectively 6 unsolicited bids, it doesn't, I don't think it says 6 interested parties, but 6 bids, then there's clearly some interest there, that's for sure.
Yeah. No, it's what's the latest on it? We had a statement, didn't we, on the 26th of March? That was just where it basically put itself up for sale, didn't it? Commenced a formal sale process. So yeah, shareholders will just have to sit and wait and see what happens, won't they? Yeah. It did say, though, not in active discussions with any party. So that was slightly odd, wasn't it?
No, I think they've rejected the previous unsolicited bids.
Oh, okay.
I think that's what happened. And then they realized actually the share price has got so low because of the Iran war. Then, you know, let's put ourselves up and just see whether they get just flush out some proper serious buyers and get an auction going. So I think they are in formal sale, process.
Got it. Okay. Yeah, that makes sense. Yeah.
Okay, good. We've got Grant. He's asking about Fonix, which is the effectively it does all the technology to run competitions on television and on radio. And he's asking what your latest thoughts are. I know we spoke, didn't we, to the CEO Rob about, I think it was last week. Yeah, Rob Weiss last week.
Yeah, no, thanks so much for arranging that call, Paul. It was really, really interesting. I actually wrote up just in bullet points, my notes from it, and popped them in my Substack on over the weekend, I think it was, or on Monday, because I do have to make an apology for this one, that whenever we mention Fonix, which we've mentioned positively for quite a few times historically, I always refer to the TV voting for game shows and Big Brother and things. But actually, Rob very calmly said to us, "So actually, Paul S," he said, "we hardly do any of that anymore." So I've been talking absolute balderdash about this, and actually it's far more about phone in and text in competitions, which apparently are very lucrative for the TV production companies. And this is, and Fonix now are saying, we've become much, much more important to the TV production companies, that where you text your response or whatever to win a holiday or anything like that, those little intermissions in TV programs, very, very profitable for the TV companies. Anyway, I came away with a tremendously positive impression of Fonix. PE was, I think it's gone up slightly since then, but the PE was only about 13, the forward PE. It's not a melting iceberg stock. That is, it's low growth, low single digit organic growth, but they've got international expansion, and he walked us through that. That was very interesting. I thought they've got a lot of potential there, because apparently this is an area where the UK leads the world, amazingly. So, and you're getting a 6% dividend yield. So I think it's lovely. I wish I had some, well, this was high up on my wish list to buy, but I didn't quite go for this one, but it's very close. So yeah, very positive. I think it's a bargain right now, around £1.50. So your thoughts, Paul?
Yeah, no, they seem to have a very good blueprint. I mean, they went into Ireland, I think, about 4 or 5 years ago, and got that to work well. And then obviously they've gone into Portugal, and then I think the other two markets are Switzerland and France.
That's it.
And essentially, they've got such a dominant position in the UK of sort of competitions, for the, I think they have something like over 90% market share. So they've got huge barriers to entry, and expertise. And the only thing that really stops them going abroad, I think, is regulation. If it's difficult to actually regulate, which is, I think, was one of the reasons why they haven't moved out to the US yet, because of the state complexity that each individual state has its own regulations.
Yes.
But essentially, just for connectivity, all they need to do is just to ink some deals with the local mobile carriers, and then they use their expertise of running these competitions for all the local radio stations and TV channels. So I think it is definitely a one-to-many model, and I think as you rightly say, there's plenty of growth still left in this business.
Yeah, and the other interesting question is, people said, well, why didn't you go after the international growth earlier? And he basically said, because we had so much to go for in the UK, that growth wasn't an issue. We were, and the team was only half the size it is now a few years ago. So he said, you've got to gradually build your team and add expertise. And it was interesting what he was saying, wasn't it, about how these things like children in need actually happen. And he said it, behind the scenes, he said it's absolute pandemonium. He basically said, you've got our staff trying to liaise in real time with Davina to tell her what to say. And he said, but they're so experienced, they've done in this. They're just really niche, really specialized, and they do it brilliantly. And because you've only got 1 or 2 hours tops, often much less than that, or sometimes just a couple of minutes to get all the revenue in without anything going wrong, the TV companies are not going to risk chucking them out and getting in somebody completely unproven to do it. So they've got a big moat around this business, I think.
Yeah, you have kittens, don't you, when you do those big sort of like competitions that give away $500,000 or something like a big Ferrari. Then you've got to be absolutely spot on to the second, and then be able to announce the results. Another share that had a bit kittens this week, unfortunately, is Burford Capital, litigation finance. They basically fund litigation cases around the world that, if it comes into if the court actually adjudicates in their favor, then they make a lot of money. Anyway, one of the cases was against Argentina, when they expropriated the oil field services, or an oil drilling company in Argentina about 15 years ago. Anyway, it went to the US court. They lost it, and the shares got absolutely hammered by down 40% or so. How do you view sort of stocks like this?
Well, I don't invest in this sector, the litigation funding sector. I just don't like it. The risk reward is all wrong for me. It's, huge upfront costs, then a speculative return that could be years away. So on that basis, I've just never invested in any of these things. And I mean, Burford is the market leader certainly in the UK. And I mean, historically, it was a massive multi-bagger, wasn't it? So I'm sorry for holders that obviously the wheels have come off, but you'd have to really do quite detailed research on some of the parts, really, wouldn't you? And they've said that some of the I think they've said they're not going to, they haven't got issues with covenants anymore, I believe, but they did say there might be they're going to be write-downs, but they haven't quantified how much as yet. So you're in a bit of a don't know type of space, and I think they said it could affect their ability to draw down on fresh loans. But they have said that the core business is still trading well. So it's a special situation. So people need to really do their own in-depth research on it. I don't have an opinion.
Yeah, no, I'm with you. I mean, it's basically just large, lumpy deals, isn't it? And you either win some or you lose some, and things can move very rapidly. It's very difficult for a shareholder to actually get any predictability. And if you're an analyst, how to forecast it, because these are binary events and they're just so material. When one particular case out in Argentina can take the shares down 40%, then you're right. You've got to have a strong, thick skin, I think, to invest in that particular area.
And it seems to have been one of these legal judgments that came completely out of the blue. I have got quite a few friends who have researched this thing over many, many years, and they were totally taken aback by this. I don't think it was seen as even a vague risk, but look, it just came out of the blue at people. So yeah, sorry to anyone who's holding this one, but I can't really give any view on whether it's worth holding, buying more or selling, unfortunately. So sorry about that.
Yeah, we've got a question from Drew. He's basically asking about the airlines, Jet2 and EasyJet. He's saying the airlines mentioned that they've actually got their fuel price, or the jet fuel price, hedged for 6 to 12 months. But he's asking, does that actually guarantee the supply of the physical jet fuel?
Good question. I mean, I don't know because I'm not a sector expert, but I would imagine probably not. Supply and pricing, I would imagine, were separate. But are you any closer to the truth on this one, Paul?
I think you're spot on. I mean, I think you can only hedge through derivatives, and that's through prices forward. So it's a monetary impact. But in the physical market of jet fuel, the last thing you're going to do is basically take ownership of a whole bunch of, unless you've got your own tanks, then they'll have some, but not masses and masses. So I think the physical jet fuel is different to the actual hedging contract. So I guess the fear is such that if your consumption of the jet fuel is different to what you've priced it in through your derivatives, then you're going to have a mismatch. So there is that, but I'd much prefer to be hedged out at a lower price than the current jet fuel price is indicating, though. Just on the monetary.
Yeah, that's right. Although there was something in John Author's email this morning saying that the oil price has contangoed to the deepest ever, which is basically, I don't think that was kerosene. I think that was crude oil, but which is basically oil traders saying this is all transitory and it's going to come rapidly back down to the price. The oil price is going to come very rapidly back down again, certainly within 12 months or less than that. So I always think of the dance, the fandango, when I hear contango.
I think isn't it the other way around? I think when you've got forward prices above future prices, I think that is backwardization. That's normal.
It's the same thing, isn't it?
I think that's backwardization. I think contango is actually the gas price where you've got future prices higher than near term. Anyway.
Oh, sorry. I mean that was the word he used in the John Author's used. But back. Yeah, I mean basically the current price is above the futures price. Just to clarify. Yeah.
Yeah. Okay. We got Carmed. He's asking about hVivo, and he's saying the contract with Iliad Therapeutics, which is this big challenge trial for, I think it's for whooping cough out in the States. Hasn't yet come through. He says it's worth about £15 million. I know they signed this letter of intent, didn't they, hVivo, about 18 months ago or 12 months ago, and then Iliad got the funding, but the deal for the contract, which is then back to back through hVivo, hasn't been announced anyway.
Yeah, that's right. I mean, I've just looking on my app here of our comments. The last comment we've got on hVivo was, excuse me, 29th of January was just a full year trading update. We cover all the RNSs from hVivo, and we've not got anything in our system since then. So yeah, it looks as if we're in the sort of don't know area at the moment, which of course, as you know, markets don't like, especially when you've got geopolitical stuff going on. So yeah, the share price has just been drifting down again, hasn't it? Spiked up to about 10p recently, and now it's down to 6.25. So they're okay for cash. hVivo is yeah, I've got a few. I did top slice into the big spike, thankfully. I think where something doubles, it's got to be worth selling some of them now. In current markets, so that's what I did with hVivo, which paid off quite nicely. But I'm just doing what everyone else is doing, really, sitting and waiting for news.
Yeah, I mean, I've spoken to a couple of fund managers about hVivo, and it appears as though Iliad Therapeutics is renegotiating the terms of the contract. But it doesn't mean, I don't think they've lost it, because I think they've actually done some work for them. So they're actually in there. So there is a strong bargaining position. But I think the environment when they originally signed the letter of intent is totally different to where it is now in terms of the demand supply function. And I think there's a lot of spare capacity in the industry, and therefore all I would say is that as a shareholder, you can't do much other than just wait. I think if I was owning them, I think they're going to sign it. Whether it's going to be as attractive as it was 15 or 12 months ago or 18 months ago, I'm not sure. But the main thing is that it gives them work, and therefore they can cover all their fixed costs. So matter of just being patient.
Just being patient, and it sounds like maybe the shares drifting then is justified, and we'll just have to wait for the news, won't we? Yeah.
Good. Okay, we've got Peter Whale. He's asking about Spectra Systems, which does these sort of like authentication of currencies, I think, and lots of other security sort of nice gadgets and technology, like for stamps and all different types of stuff. Had a big contract, but they came out with the results, I think, this week, and they weren't bad, actually. How do you read this anyway?
The results were fantastic. I mean, there's no PE based on those results is about a 5 or something. But it was, as we've already known for a long, long time, that was a one-off contract year. So they won't repeat that. They won't repeat that success in the following year. But I mean, I think it's very, very cheap now. I've held this through thick and thin. So you've got. The cash pile is now highly significant, or it will be when the receivables and inventories turn into cash in the next, which is in this year, because they don't get all the money up front from the big contract. It gradually feeds in. Very, very interesting, innovative company. As you say, 4 different distinct activities. It pays lovely divvies. And has done for quite a few years now. And you've got the blue sky stuff, all these various development projects. It's an innovation company, basically an IP company. You got the upside for all these new things pretty much in for free. I think it's really attractive. So yeah, I'm very, very happy with this. Not happy with what share price has done, but I think the results and the outlook, and they did disappoint. They did have a deferral of contract, but you can't avoid that when you're dealing with major central banks and the like. The signing of the contract is just not under their control, I'm afraid. So that is the main risk with this. It's just periodic profit warnings when they disappoint on the timings of things. But it doesn't alter the fundamental fact that this is a really, really interesting, successful, innovative company with some, some of the stuff they've got in the pipeline could be quite big,
How much of the revenues is recurring? I know they have these large contracts which come every 3 or 4 years or whatever it is. But apart from that, how much of their underlying revenue is sort of like, recurring or repeat? How much visibility do they have?
I'm not sure, but I think it's about half of I think they're forecasting revenue to roughly halve in the new year. So what they've got, and they do have some maintenance and support contracts and whatnot. This is you. I mean, you've correctly identified the main problem with Spectra Systems, which is that it's large, lumpy, unpredictable contracts, and you just have to accept that when you buy shares in it. Which is why it's the sort of thing that you want to buy when everyone hates it and the valuation's absolutely bombed out. And then probably with hindsight, we should have been banking some profits, really, shouldn't we? When everyone loved it. It did get to be quite a crowded trade in 2024 with hindsight, but there we are.
Yeah. Okay, good. We got lost in the fog. He's asking about Activeops, which is what I know. It's one of my biggest positions. These guys do sort of like employee sort of management and efficiency and productivity for banks and for health insurers and also for business process operators. A typical example would be if you've got a large sort of like employee base who's some of it's in the office, some of them are at home, etc. And you may even have bots, and you want to manage that whole large disparate team the most efficiently and most productively. Then their software allows you to do that, and the stats allow you to do it. Anyway, the shares did very well in January after that, and then they like everything else with the agentic AI sort of fears came crashing down. Any thoughts on this one?
Not really. No, I've never really understood the valuation on this. Even now, I mean, to me, I can't see the attraction really. So tell us why you like it, Paul, because I don't get it.
Yeah, I mean, it's about 90% recurring revenue streams. Again, about 90% gross margins as well. They're growing their top line at roughly around about 20-25% ARR organic growth. They bought this business in Australia that has a large presence in America. And together they've now got one of the biggest footprints out in the US, where they're seeing a lot of demand for corporates who actually need that to improve productivity and efficiency, particularly, as say, in health insurers and in financial services. And just to give you an indication of the quality of what they offer, they actually lost a big UK bank contract about 3 years ago. The bank then moved to a competitor, realized that actually they were nowhere near as good as Activeops, and then came back to Activeops and re-signed. So I think if you look at it through every single lens in terms of ARR growth, organic, you look at it scalable gross margins, and you look at it sort of how good the actual product is. It hits all those marks and ticks all the boxes. So I own it. I've obviously seen it come down sort of £1 since it topped out in January. I'm just going to hold this. This is just noise, is the agentic AI, because effectively they'll be able to put in a lot of agents into their software, and it'll just improve the quality of that particular business. I mean, if going forward, big health insurers and big banks want to reduce their cost base, and if this seems to be one of the best players in the market to do that, I'm not worried about the profitability at the moment. I'm just concerned. I just want them to carry on growing at 20-25% ARR organically, and if they do that, then the profits will come. And I'm very happy to hold. And you just got to, if you're gonna go into sort of like sort of software stocks, then don't worry about short-term gyrations and sentiment. I think they'll come out with a trading update probably in the next month, sometime in April, early May, because I think it's a March year end. And I think they'll knock the ball out the park in terms of that top line growth. I just want them to carry on doing that. And this business will be worth a lot more in 3 or 4 years' time. But you've just got to take this sort of like 30% drawdowns that you occasionally get in these type of stocks.
Yes, I mean, I take all of that on board, and I'm sure you're right, because you know it much better than I do. But for me, I think the whole software sector got way too expensive, fueled by private equity money, paying ridiculous multiples to buy things. And I think that's a bubble, and I think that's burst. So to my mind, these prompted by, as you say, the AI thing, which I think has been indiscriminate, and the good ones should gradually recover, I think. But I personally think we've just seen a structural sort of step down in valuations on software companies from way too expensive to just expensive. that's
really interesting actually, because I think you're going to get even more disparate sort of valuations. I think the ones where you're going to get disintermediated and actually hit by agentic AI, I can see those businesses, losing market share, losing pricing power, losing margin.
Yes.
But for the ones like your Craneware, Activeops, and other ones in that Eleco, where you've got actually entrenched within companies, then they should be the biggest beneficiaries. So I could actually see AI accelerating their growth and accelerating their margins, because what you're doing, if you think about it, what you're doing is accelerating the benefit that you give to your clients. If they can take out far more of their labor headcount by adopting that software, then those businesses are delivering far more value to those particular clients, and therefore you'll just share some of that extra value. So I actually think if you're in the right place at the right time, I think it will accelerate those businesses rather than actually knock them. But if you're in the wrong place, then I think you're going to be hit.
I think that sounds completely sensible to me. I agree with all of that. I mean, we got this, didn't we? This crazy sort of mass sell-off that started on NASDAQ and then spread quickly over here too, of suddenly a panic. Oh my God, AI is going to destroy everything. And it seems to me you can rummage through the wreckage and find some really strong enterprise software businesses that, as you say, you're not going to get AI even touching their business models because it's so embedded in the client, so complex, rapidly changing as well, and they can actually utilize AI to make their businesses better. So yeah, I'm 100% with you on all of that, Paul. Yeah.
Okay, well, let's go to one. Let's go to the gaming sector. We've got Kevin. He's asking about tinyBuild, which I think you own, don't you? It's basically it's a Ukrainian games developer, I think, that has quite a good sort of like back catalogue. It's mining. Anyway, the shares got totally crushed about a year ago, but have started to perk up as the trading has improved. How do you see this one?
Well, I bought it after a Christmas party. It was actually in a St. James's Club, a claret tasting lunch that went on till about 8 o'clock at night. And
it might be the one where me and you were in the same one, weren't we?
No, it was a different one.
Oh, was it? Okay.
Yeah. And basically, one of the guys there, who's great fun, loves finding obscure nanocaps where something's happening but the market hasn't noticed. And he flagged this to me and said they've got a blockbuster game called Kingmakers coming out. So I did some research on that, and I thought this does look interesting. It was on the brink of going bust, basically, tinyBuild was, after doing an IPO where the founder took out 50 or 60 million quid and then ran the business into the ground over about 2 years. So the history of tinyBuild is diabolical. However, the more research I did on it, the more I thought, actually, this is quite interesting because they're not dependent on blockbuster games. They've got, as you say, they've got a back catalogue of about 90 games, which generate 85% of their revenue. So it's repeating rather than recurring necessarily revenues. They build them into franchises, and they've got several that are coming good on that, including one called Hello Neighbor. And they've had constant delays. They haven't launched Kingmakers, and there are even question marks out there on the internet as to whether it's ever going to be released or if it's just too complicated a concept. So what started off as a bit of a moonshot on Kingmakers, after the recent results, which were ahead of expectations, and the cash position stabilized, it generates lots of cash, recycles all of it into new game development. The guy running it seems to have calmed down after a near-death experience, and he did bankroll the rescue placing. He could take it private because he owns about 60%, but he hasn't done. And to my mind, if he intended to do the dirty on people, he probably would have done that by now. So, but that is a risk, delisting risk. It's actually not a bad business if you look at the most recent numbers. So I think it's worth more than the current share price. So this has now morphed from a moonshot sort of punt into actually it's not a bad little company type of punt.
Yeah, it sounds as though that sort of claret is something you need to do to pick up good stock picks. But just more broadly for gaming companies, how do you think agentic AI will actually impact them? Because I believe there's some crazy stat like last year there was 20,000 games released, so it's quite a crowded area. And if you've
crowded, yes.
And the thing is with games is that it's a software company to individual type model, consumer. It's not enterprise. It's not massively entrenched. Effectively the stickiness of these things is not huge unless you have these, some massive gameplay type operations whereby literally you've got millions and millions of people, or you have a huge franchise, then there is barriers to entry and stuff like that. There's sort of longevity because you could get it such that, with agentic AI, you now get an even more proliferation of mobile games, and some of them are very good, which hit the market. You just don't quite get that visibility as you do in the software sector for enterprise systems.
Yes, all perfectly valid points, Paul. And normally I don't invest in the video game sector at all. So this is purely a valuation anomaly, I believe. I think basically it's worth 2 to 4 times the current share price, and then that's my target. And if I'm right, I'll sell them, and move on. But all the points you make are perfectly valid. But if people actually look at the most recent accounts, and particularly the cash flow statement, this thing is churning out cash, and a lot of its games are now franchises, which take between 5 and 8 years to build into a franchise. Then you do regular updates and whatnot. And those become quite valuable once they become franchises. So there's a couple of good webinars that the company's done where they explain the business model quite well. I think he said something along the lines of that AI is not really much use for games publishing right now, but he said he thinks 2 or 3 years' time it might be more usable. So but as I say, just a valuation anomaly, I think, on this one. Not, it's not a buy and hold forever type of share.
Okay, good. Let's go to EdTech. We've got Brian is asking about Tribal. I mean, I actually own these guys. These basically do software systems for universities, for student management, and also for course management, recruitment of students, and then they do the alumni at the end. Plus, they've got a sort of EdTech services business as well, Etio, which is like they came out with, I think it was full year results, which were very good, but their outlook was definitely disappointed people, because I think a lot of people, myself included, were looking for upgrades in 2026. And then it was worse still. They actually did put new figures for 2027, which were down on 2026. So it was a double hit in terms of the outlook. What was your take anyway?
Well, we only looked at it briefly on my Substack. PBT was great, wasn't it? Up 136%. But the EPS dropped 6%. I don't know why there was a mismatch there. Maybe tax. I don't know. So we reckon it was about a 6% miss against consensus earnings per share forecasts. So that was a slight negative. But the outlook seemed to be in line with expectations. So we were a little bit surprised this dropped on the results. And I mean, it looks good value, and Harvard have got 15%. So no, we were surprised it dropped as much as it did. But do you want to elaborate a bit more on that one, Paul?
Yeah, the whole story was their outlook for 2026, and more importantly 2027, because they've done so much good work in 2025, upgraded expectations twice, generated a lot of cash. They had about 11 million of net cash on the balance sheet at the end of the year, and therefore everybody went into the results thinking, actually, they've upgraded so much, they haven't changed 2026 numbers yet, therefore we should be out, because they're very old and out of date, we should see an upgrade. And then they basically said they're getting hit by a couple of things. First of all, as they migrate their universities to this cloud, all singing, all dancing cloud platform, which is going really, really well, and the demand's increasing. As they're doing that, they're having, because of the budgetary constraints, they're having to actually discount the professional services, the one-off cost to help them migrate and get them into. So you've got a short-term hit in your professional services gross margin because of that. Plus, they've got a shared center out in the Philippines, and they're getting a 4x hit on that because they pay for it in Philippine pesos, I think it is, which is strengthened against the pound. So that's also taken it out. And then they've got this really large contract out in Australia with New South Wales, I think, a university business. There was actually terminated about 3 or 4 years ago, but they've kept on using it, and they're still going to use it to a certain extent this year in 2026, but it's going to drop out in 2027. So when you put all that together, then unfortunately you got the business albeit it's getting the core business is getting much stronger and is in a really good place. Optically, the headline sales and profit. Well, headline sales is only going up very marginally for 2 years, and profits are actually EPS is going down. So that's why people like me were thinking, well, crikey, that's I'm going to have to wait another 2 years until the business starts, sort of really sort of generating top and bottom line growth. I think it will come because, I spoke to the CEO and the CFO, and I said to them, I think your business is in the best state it's been in for 5 years. It's the underlying core is good, and the demand profile from the university is good. So it's going well. But when you put out those type of forecasts, it's just total ho-hum. People think this business it looks like it's going nowhere, even though that's disguising underlying. It's in a much better, the fundamentals are much stronger. So I was not surprised it sold off as people just thought, oh, crikey. I thought everybody went in, well, not everybody, when I went into it thinking it was going to knock the ball out of the park. But it actually reduced the bar. When it put those 2027 numbers, which was down on 2026, I was pretty disappointed. But personally, I've got a good position in this. I'm going to hold it, because I think the underlying business is worth a lot more. I was just disappointed that wasn't seeing some of that benefit come through sooner than actually 2028.
Yeah, I mean, that sounds very sensible to me. I mean, we only looked at it briefly, but I've just been quickly scanning the results while you were talking, and there is a much, much higher tax charge in 25 compared with 24. So that's probably, the tax charge to the P&L was almost tenfold increase. So that is that is why I think the earnings per share figure dropped. And the balance sheet's reasonably straight now, isn't it? It was problematic in the past. I can't really see anything wrong with it.
No, there isn't anything wrong with it. It's just that, as I say, people were disappointed after the numbers.
Short-term disappointment. Well, in that case, like you say, it's just a hold, isn't it?
Yeah,
you just tuck it in the bottom drawer and forget about it.
Absolutely. Okay, we've got Lemon Physical. He's asking about Keystone Law, which I think is a legal services business that I think they were on a bit of a buy and build, weren't they? They were sort of like buy people in, improve performance, but they take them on those sort of partnerships. I don't know if you've got any quick thoughts on that one at all. They look as though they've come down a bit, but everything else has come down a bit this year.
Everything else has come down. Yeah, one of my readers, actually, subscribers, wrote a really interesting article about this, because we publish reader material as well that we curate, and it sounded very persuasive, the business model. They lots of organic growth because they just take on sort of freelance solicitors who bolt onto their services platform, which enables them to run their own firm, and then Keystone just sits in the middle and takes a cut of their billings. So lovely business model, and each year they just take on more sort of self-employed contractors. The main risk is if the Inland Revenue go for them and say, well, these are not contractors, these are employees. So that, I think the IR35 thing, that is the main risk here. But we don't know why the shares have just plummeted. It's come down. It was when the reader wrote the article, it was on a PE of about 20, and we thought it looks lovely, but a bit pricey. Well, now it's down to a PE of 13, and you've got a 5.2% dividend yield as well. So yeah, I would say this is worth a fresh look. I remember thinking at the time, gosh, I like that business model. So it's quite differentiated.
What's the balance sheet like?
Balance sheet is modest. 12 million net tangible asset value. That's as at July, so we're waiting for the January figures. So yeah, it doesn't have much on the balance sheet, but it doesn't really need much.
Yeah.
So and because the it's basically a platform, a service. I know that word's overused, but it is. It doesn't need much actual capital. The solicitors do their stuff, and it just sits there providing them with common services. So I like the business model. Worth a closer look, I'd say. The last news we had from them was a trading update on the 18th of February, marginally ahead of expectations. So it doesn't look as if there's anything gone wrong with the business. I think somebody said they were worried about AI, but a couple of solicitors who subscribe for my Substack said actually it's probably more of a benefit for lawyers. They're using it in lots of ways. Here's the old lease, here's the new lease, bang, shove it through AI, and it just produces a letter to your client saying, here are all the differences, so it's automating a lot of their manual processes. So I think this is worth a fresh look. And the other lawyer actually that is just in free fall, and again, we don't know why, is Gately. So if anyone listening knows about Gately and why that's plunging, let us know what you think.
Yeah, I just on their balance sheet, haven't they got sort of net debt, or is it a net cash position?
No, it's 6.5 million net cash, 12 million net tangible assets. So it looks all right to me.
Yeah, okay. And then with agentic AI, I mean, most lawyers charge on a per hour basis, a bit like the accountants. Sure. And if you're doing that and then you're putting AI, you could imagine your those rates per day or rates per hour are coming down big time. So you might find that actually gets a lot more competitive on those rates, which is why you can take your cost out. You can take your costs out, but I suspect because you're not, it's going to be you're going to see some softness in pricing, because you're already seeing that in the accountants with the likes of KPMG, BDO, and these kind of guys for their audit services. When they charge people out on a daily basis, their clients are demanding that they actually use AI and therefore can reduce those fees on a they either reduce the days or they reduce the fee, one of the two.
Well, that's interesting. I'll keep my eyes peeled for that. I haven't heard anything like that myself, but what was your source on that, Paul? If you can disclose it, I don't know.
Financial Times.
Oh, okay. Yeah.
But I mean, it could be wrong. The point is such that when you're in a professional services business, unless the market size, the TAM, grows by how much the pricing or the cost per day decrease, unless it grows by that, you're basically going down, aren't you? The size of the market is reducing, because if everybody still does the same level of work but the price of it goes down, then clearly the size of the market, the value in monetary terms, goes down as well, unless you've got more work to do, which is possible. But let's be clear about it. If you're a company, then you've got an issue where you need a lawyer, then are you going to need a lawyer twice? I don't know. I mean, probably not.
I mean, I could see companies dividing into two, the legal practices and the audit firms that really grasp this stuff and use AI effectively are going to clean up, aren't they? Because like you say, they'll be able to charge less but get more done. So I suppose scrutinizing the RNSs from all these listed legal and accountancy firms, we need to be asking them on webinars, give us tangible examples of how you're using AI to actually save money and make yourself more efficient. And if they're just giving you sort of performative answers or general waffle about AI, then it probably means they're not taking full advantage of it as they could. So it'll be very interesting to see how this pans out.
No, it will be, I agree. I think the margins for these professional companies will increase because they'll take the costs out faster than the pricing will change, because they're ahead of the game.
That rings true. Yeah.
But I think they're going to struggle with the amount of revenue on the industry. But let's wait and see if it might take. Okay, we've got Annie, I'm Not Your Daddy, asking about oilfield services company. Plexus, which I know you.
Oh God, I didn't want to talk about this one really.
Okay, we'll keep it brief. I know it's been one of your biggest positions for some time, but I think they came out with a trading update. Not surprisingly, the Middle East has taken some of the juice out of the rented equipment sector for sort of like wellhead services, isn't it?
Yeah, it's very disappointing. I mean, I didn't expect them to meet the forecast, because they put out hockey stick forecasts to get the fundraise away. But I didn't expect them to miss them by a country mile, which is what they've done. So very, very disappointing update. I think for most people now, this is just, it probably always was, uninvestable. So I don't tend to talk about it much on my Substack, because it's just not Now, I caught that 10-bag move that you can see in the middle of the chart there, which was where for several months the company had already announced a record ever high margin contract, which was a company maker really, and that's why the shares 10-bagged. And the subsequent 2.5 years, it's just failed to execute really in terms of repeating on that contract, unfortunately. So it basically just hasn't worked. I mean, there's no, I was fully aware of the risk reward on it. Obviously, what would I do differently this time round? Well, when I 10 bagged on my original stake on it, I would have sold them. So next time I find a nano cap 10 bagger, which every few years I find one, I'll just bank the profits and move on, or at least sell half. So that's the lesson I've learned from this, whereas I've resolutely held on to them now. But I'm fully aware of what risk reward was. Obviously, apologies to anyone who followed me in on this, but I've never egged the story. I've always sort of said to people that this is high risk, not for widows and orphans, whatever. It just basically hasn't worked. I mean, I don't think it's a zero, because the technology is very valuable. In the past, the trouble is as well, they clearly need to raise cash. And the RNS said something like, we have enough cash for the immediate future. And I thought, oh, that's all right. Then I thought, what? It's not all right. that means they're going to run out soon. So nice try by the PR there, but it didn't fool me for long. So yeah, it's going to have to raise more cash. But in the past, remember the original management owned 60%. They've only diluted once in the last 10 years. They always seem to find something down the back of the sofa. They sell off little chunks of IP. I think the end game on this is probably that it just gets sold to Schlumberger, because the technology is very valuable. I mean, that £9 million contract saved the client over 100 million quid or dollars. So this is valuable, but they've just, and the Plexus was worth 300 million market cap 10 years ago. So this technology is real. It's just that they can't seem to execute in a way that delivered what I hope it would deliver. So it hasn't worked. I'm not bailing out. I'm just in for the duration, and I've kind of written it off. It's in a side pocket. That's that. Didn't work out, unfortunately, but we'll see what happens.
Yeah. No, I had a look at another company called Diversified Energy, which is an oil and gas explorer, or effectively production business. It's on AIM, or I think it's on AIM, or it's on the FTSE anyway. What's
it called again?
Diversified Energy, and they basically produce oil and gas in America, and they've got they've got about 70,000 wells to plug and abandon over the next they've got an enormous amount over the next 30 years. Now, admittedly, this is onshore, not offshore, because I think Plexus, but the way they're doing it was quite interesting. They're doing it internally. They've basically decided, we're going to create a division to do all the plug and abandonment ourselves, rather than actually use other parties and other people's technology. So they're doing that, which was quite interesting, which I think it sort of chimes with what Plexus is. It's it's got a lot of very good technology, but it's quite niche. It's not mainstream. And you need, and that's what you need. You need basically the sort of, the price point to be able to use, and the POS grip device, essentially. I think that's what it comes down to. So if there's instances whereby they're highly complex and demanding wells that they need to plug and abandon, or carbon capture in particular, I think is difficult. Then step forward Plexus, but you need more of that, I think, is probably where, and at the moment with the oil and gas, effectively companies, particularly out in the Middle East, not doing anything, everybody's just sort of like, okay, well, let's see how we get on first.
Yeah, I mean, Plexus did say that their Middle Eastern contract, they've just gone back into the Middle East. Unfortunate timing. They said actually that contract was recommencing in, I think, a couple of weeks or something. So it's not, it doesn't seem to be the case that and also plug and abandonment could and carbon capture could both be very big for Plexus.
Yes.
It's always running on empty for cash, and it's been a very frustrating investment, but I'd like to get closure on it, really. So I hope that they'll just sell. I hope that they'll just sell the business, really. But it hasn't done what I hoped it would do, unfortunately. So that's life.
Yeah. Okay, we've got Paul the Parrot. He's asking about Anpario. Basically, these guys do, I think it's gut health products, all natural, that go into, I think it's cows and sheep and probably pigs and stuff like that around the world. The shares have done very well indeed. They bought they bought a company where they do a capsule in a capsule, I think. Biovet, I think it was called, a couple of years ago, which has gone brilliantly. Anyway, the business has gone from strength to strength. How did you see it?
Very good. I mean, this has fallen a lot recently. I think I put this on my bonkers bargain spreadsheet actually recently. Very, very good value now. I think it's just been caught in the downdraft of the general market panic. You know, people selling their illiquid things and then selling feeds further panic selling, doesn't it? So yeah, very much into attractive value territory, I believe, Anpario. So yeah, I like this one.
Okay, good. We've got a quick one from Andrew. He's asking about Lords Group Trading, building products company. I think they've sort of like improved. They used to have an issue with the debt, I think, but it's actually started to come down. Any quick thoughts on it?
Yeah, they did a sale and lease back, which helped bring the debt down, which I'm not generally keen on. That's usually a sign of a company in trouble. But on the other hand, it's better to have debt off balance sheet. Well, it's on balance sheet, but you know what I mean. It's safe debt that can't be pulled out from them on leases, rather than bank debt that can be pulled. So we've not had any reports from Lords since the 27th of January. I don't know if there's been anything. I mean, I expect they'll probably just say everything's subdued, because the building sector generally is subdued, isn't it? But the update on 27th of January was in line. Like-for-like sales were kind of bumping along slightly positive, but flat effectively. And a big increase in renewable heating sales, which they're involved in. I'd have to look at more up-to-date numbers. I don't think we've seen the 2025 numbers yet. We got a trading update, but not the actual numbers as far as I can remember. So don't know. That's in my don't know tray at the moment, but I'll be all over it when the results come out. So look out for that when we report on it.
Yeah, I think there's a big pricing gap between Travis Perkins, which is the biggest dog in the market, versus Lords Group Trading. They basically do the same sort of thing. And I know Lords over a long time has been winning market share against Travis Perkins. The thing is such that there's so much worry in sort of like, the building products, particularly on the merchants at the moment, that people have sold this sort of like the perceived smaller player and gone for, if they're going to hold, they keep the bigger one, which is Travis Perkins. If the market improves, which I think it will sometime this year, then this is a big cyclical we'll see a lot of cyclical upside, big beta play on it.
It's come right down, hasn't it? Only 17 pence. I mean, it peaked at 54p last summer. So I think that gives you some indication of what the upside could be once a cyclical recovery does start. So it could be quite interesting. It's family controlled, isn't it? Owner managed. So you do have, I suppose, the delisting risk. Very small free float. It seems to be in really 8, 9, 10 shareholders own nearly all of the company. So that's a possible drawback. So yeah, I mean, worth a look, I'd say. Yeah, it pays a divvy as well, 3% divvy. So yeah, Lords, it's in my don't know tray, but certainly once we do start to see green shoots, and once the Iran thing hopefully is resolved, sooner the better, this could be on a short list of things that could be worth researching in more depth. So yeah, I wouldn't try and turn anyone away from it, put it like that.
Yeah. Okay, good. Let's move to media. We've got Future Group. Who was asking about it earlier on? Yes, Martin was asking about it. And it's gone from back in 2021, when the shares were roughly £38. It's now trading at £2.80. Is it a dying business, or is the value here?
Well, I'm afraid we got this wrong. Up until the 5th of February, we were either green or amber green on it because of the value, but it just got cheaper and cheaper and cheaper. So when the big sell-off happened with the software companies, I looked into this one as a potential something to buy. And I actually was put off from reading the annual report. So I dropped it down to amber. And I've mentioned in my podcast that I've turned more negative on Future Group. Because it does look like a dying business, I've got to say. The main website has got all these brands for traditional magazines, which it then digitized. Well, they're all in decline now. So it's now just instead of a declining print business, it's now a declining print and digital business. Over 4 years, if you look at the trend, it's all going the wrong way. And obviously they got a double whammy because then I think it's Go Compare, isn't it, that they own? Well, they've been clobbered by the AI worries, the price comparison websites. On the plus side, Future, and then of course it put out a profit warning recently, didn't it? In the last few days, I think, and the shares dropped a lot. I mean, at what point does it become so cheap that you can't ignore it? That's the big question. And I think the only thing I would flag to you is that it's carrying a lot of net debt. So although the market cap looks incredibly cheap and the PE looks cheap, the E side of that keeps dropping. And you've got to add on this 276 million net debt, which they squandered buying back their own shares at prices that are now way above the current share price. So it's not a pretty picture, really, is it? So for me personally, it's one of those things that you might get a fierce bounce. Could be a rebound trade at some point, but longer term, I'm not convinced, I have to say. So I think it's a bit of a value trap. So I'm amber currently, neutral on Future.
I think, I'm with you. I mean, I think the revenues are going to be under pressure going forward, and worse still, I think the costs are going up as well. Your cost per click on Google, etc. And I just think,
oh yes, was that the company that mentioned that recently? I think it might have been.
Yeah. There's been a few, but I mean, if you just look at Google's, if you look at Alphabet's recent or quarterly numbers, you see search is increasing, and it isn't volume of click-throughs which has been rising. It's basically the cost per click has been increasing, and they've done very well out of it. And unfortunately, if you're paying those increased prices to get traffic, then that's going to knock your profitability and your costs. And then likewise,
that's right.
And then likewise is how much sort of like first party traffic are you getting to your websites? And the answer to that is less. So you've got revenue decline and you've got you've got cost increase, and that sounds like bad news to me. I wouldn't. I don't know what the problem I have is actually coming up with a value for the business, because I don't know what the steady state is. You've just got you've got the top line going down, and then you've got the costs increasing, and it just is like, okay, that's going against
I think you should take a bow on this, Paul, because to be fair, you've been on about this for months, saying that the blue Google Links side of things is plummeting for lots of businesses, and they all say, "Oh, we're not dependent on the blue links and everything." But actually, I've just refreshed my page, and my notes from yesterday came up on Future's profit warning. They again obfuscated, just talk about EBITDA margins or whatever. Why do they do this? The PRs try to kind of hide the damage. Why don't they just say, look, profits are going to be down 15 or 20% or whatever it is? Instead, they leave us to find out, which we will have done within 2 or 3 hours, by which time we're really annoyed with the company and the management for trying to hide it. It's just ridiculous. Whoever's advising these companies are absolute muppets, and they're doing damage. They are doing damage because you don't trust the company or the management. Yeah, they said basically the impact from Google search and results are going down, and they're having to pay more for the per-click ads, taking a cautious view. EBITDA margin was forecast at 30%, will now be between 25 to 27%. Well, that will feed through to a bigger drop by the time you've gone through to PBT, won't it? Because your finance costs don't drop. So I'm a bit wary about this one, I have to say. Although obviously optically it looks dirt cheap on the PE, but as you quite rightly say, we don't know what the earnings are going to be, do we?
No. I think there's lots of read across on this one. I think Money Supermarket is going to, or Money as they call themselves, is equally going to be under pressure. Maybe not as much. Eventually you're going to get the same sort of thing with probably Auto Trader. You may not so much with Rightmove, and then you've got LBG Media as well, which is all the same sort of thing. If they've got this sort of like digital real estate, well, the digital real estate unfortunately has gone down, and the value because you're just not getting as much sort of your traffic. You're not as dominant as you were before, and you're paying more for the traffic. So the economics has flipped totally.
I think you're right. And LBG, I'm not positive on that anymore. And I'll tell you why. I think I mentioned it before. Their Facebook page is just swamped with AI generated videos, and people hate them. People hate them. I mean, there was a nice dancing cats one, which I did like. But they got, man just escapes disaster by climbing out of the lorry that topples over down the hill. And the reader comments, hundreds of them, saying, this is rubbish. This is AI slop. Stop wasting my time. So they're completely alienating their followers. And any business that does that, as asked Gerald Ratner, is going to be in trouble. And Rightmove, news today, there's a class action against them, isn't there, for monopolistic pricing? Yeah.
Yeah, I think there's been one of those before, actually. I know they've had a lot of pressure from just putting too many price. But anyway, let's wait and see. Let's see how that gets on. Okay, we did the last couple one. We got David Raywood. He's asking about Strix, which is the kettle heating or kettle pressure control business that sold one of its divisions, I think, which was a water dispensing company. I can't remember what it was called. Okay, and then the shares jumped up. Anyway, the shares have gone back down, even though the balance sheet's sort of fixed. How do you see this one?
Well, I mean, I always thought this looked very peculiar, this share. I've always been highly suspicious of it, but I'm not anymore because the deal they did to sell Billy, it was called, wasn't it? Was phenomenal. Absolutely astonishing for 105 million quid. Bizarre. But anyway, it's transformed the balance sheet, now sitting on cash, as your correspondent has pointed out. I think they've done a buyback, haven't they, or announced one. The last news I've got on it is 9th of March, which was a trading update. All the debt's paid off, raising prices due to higher costs, reduced inventory, early signs of improved trading, they said in Q1, but mixed overall. So, I don't know. It's a strange company, isn't it? I've never really been particularly drawn to it, but it looks the best it's ever looked, given that they're now sitting on this cash pile. So yeah, it could be worth people having a fresh look at it.
Yeah, I don't know what their competitive moat is now. I know they're supposed to be safer and more, but I think and they do have patents over kettle control. But to me that sounds pretty commodity-like, and they might, and I don't know. It wouldn't be something I would rush to. I think they need to have. They went into Billy, I think, to diversify and to get new IP, such that they could actually, sort of like improve it. But in all intents and purposes, they've gone back to Plan A, and I think the competitive moat around that business is less now than it was sort of like 5 years ago. So I can understand why the shares, because with the China competition, I mean, it just is so tough, isn't it? Really, or just Asian manufacturing.
Yeah, exactly. I just avoid anything that is just focused on China, because we've had such terrible experiences on AIM. Remember all those 2015 floats? 32 of them, 31 of them were frauds.
Yeah, I know, it was terrible.
So yeah.
Okay, we've got one final one. Let's go. We've got Neil is asking about Bioventix, which I think does these monoclonal and cheap antibody things that go into diagnostics. So to give you an example, they do a lot of their reagents go into tests for vitamin D, I think, which has been their sort of core product. And now they're developing more reagents, more assays to do other products like Alzheimer's, I think. The shares responded pretty well, actually, over the last couple of days after some quite reasonable upbeat comments from their results.
Yeah, well, that's what I thought. We had gone no color on this, which is our system of just saying we don't know how to value it. Excuse me, but I did have a quick look at the results, which came out literally a day or two ago. And I thought, this thing looks unbelievably cheap. The dividend yield, it pays out all its earnings in cash. Dividend yield was about 10%, I think. And PE of a similar amount. And profits were slightly down, but not that much. And as you say, the management speak for management who I think are very highly regarded. It's a group of about 10 or 12 boffins, basically, the company is, and they're very, very highly regarded. Tell it like it is, trustworthy people. I looked at this, I thought, this is too cheap. I mean, surely. So at £14.75, I stuck it on my bonkers bargain spreadsheet and just thought, at this valuation, surely risk reward is favourable. I think there are question marks over the longevity of its of its legacy type products, but it sounds like they've got a good load of stuff in the pipeline as well, as you rightly say. So I think, on balance, as a complete non-expert, I wouldn't know what a monoclonal sheep antibody is if I ran into it in real life. So but I just think the numbers are saying to me, God, this thing's got to be oversold now. I think it's relentless fund selling, redemptions, illiquid stock, just a 45-degree downwards share price graph, isn't it? But at some point they bottom out, don't they, when they're decent, profitable, cash generative companies? Maybe I see it's up 7% from the recent low. That's a start, isn't it?
Yeah, I was really quite impressed about their Alzheimer's new reagents or assays going in, because they did actually name in their outlook statement that they are backing 3 out of the main protagonists who are coming out with these Alzheimer's diagnostics. And if they're doing 3 out of, I don't know, 5 or 6, then they've got a lot of sort of like, horses. They're betting on a lot of horses who are going to be successful. And if they get that successful, that Alzheimer's will be much, much bigger than vitamin D, because it's enormous. We all know it is. And if you can get to do an easy blood test that works and quick and is accurate, and I know there's some big guys in there like Roche and other big sort of diagnostics businesses, and if they're actually using Bioventix's diagnostic, I'm very positive actually in that respect. I'd have to do some more digging to see which horses they're actually backing, but I think that's probably going to be commercially sensitive information, because they won't be able to tell you about that, because their customers won't allow them that level of disclosure. But you never know. I might do a chat GPT. But to be honest, I'd written that Alzheimer's test off, because I thought they were just backing one. But given that they're backing so many horses in that particular race, then I think they've got a decent chance of winning that. And if they do, this is going to be Alzheimer's testing diagnostics is going to be massive, absolutely massive. But whether, let's wait and see whether they actually come through with it.
Yeah, and historically, they've spent quite a few years developing these very niche products, but they then have a big moat around them, don't they?
Yeah.
And I think the big farmers pay, huge profit margin. I mean, the PBT profit margin at Bioventix is one of the highest I've ever seen. I think it's nearly 80%. Yeah. But it's basically because it's smallish volumes with big farmers who just have to have that particular product for whatever thing they're developing, and they just pay up without question, and there's no competition effectively for years and years and years. So I mean, it does seem but you'd need to look into the patent expiries and all that sort of thing. I think it's one of those granular things where a lot more research is needed. So my view is only very superficial, but just basically on the numbers, I think it looks very attractive valuation now. For further research,
Good. Okay. Well, we've been going now for 75 minutes, so we'll call it a day. Thanks, everyone. Thanks, everyone, for your questions. How was my video, Paul, in terms of it's still grainy, is it?
I've had other screens on most of the time, but it seems a bit better now.
Okay, well, what I might well do, I'm going to try next week. I'm going to try and sort out this technical issue, and then I won't say we're going to do it next week, because I want to get the technical issue sorted out, because it just keeps recurring, and it's significantly annoying that I can't actually put charts up and all kinds of stuff. So
if you want to do a private test with me, just let me know, and we can try it out, can't we?
Yeah. Good. Okay. Well, thanks, everyone. I hope you have a good Easter. And I was just delighted to get through the Q1, because we might now hopefully have bottomed out and starting to move forward. So thanks again, Paul. And we'll see when we've sorted. We'll talk again when we've sorted the technical issues out.
Great. Thanks, Paul. Thanks, everyone. Have a lovely Easter.